Everyone, Keshav Kalor here. So today we're going to be talking about oil and gas investments. Our agenda, we're going to start with why oil and gas, or how oil and gas works as an investment, why this makes sense, our strategy, how do we go about investing in oil and gas for great tax benefits, W-2 tax benefits, capital gains tax benefits, any sort of taxable income you have without too much risk. And we'll discuss case studies because we've been doing this for 2 years now, and our partners have been doing this for 18 years. And then frequently asked questions. So a quick disclaimer for everyone listening at home, John and I, we're not financial, legal, tax, any such advisors. This is simply educational in nature, and past performance is not a guarantee of future performance. These are all projections. We recommend that before you make any investment decision, which always, all investments come with risk, always consult your tax, legal, financial, any such advisors in your life. So, introduction. John, I'll let you take it away from here.
Very good.
Oh, wait.
Thank you.
Let me share my screen also.
Yeah.
There we go. Can you see my screen?
Yes,
Okay.
I can. So oil and gas is an investment. Of course, we're going to talk about a lot of different asset classes, but today we're going to focus on oil and gas. And if anything, you take away from this presentation, take away these key points and refer to this particular slide in specifically. So first and foremost, why do we love oil and gas? It's because of the tax benefits, right? Unlike other asset classes where you might be able to deduct a little bit of the deductions from cost segregation. With oil and gas, you're able to deduct 80 to 90% of your investments in the first year that you invest. So what that practically means is that if you invest 100,000, you'll be able to deduct 80 to 90% of that. That deduction can be made against any income. So unlike other real estate and other type of private equity, where you can deduct only against other passive income, with oil and gas, you can deduct these 80 to 90% tax deductions against your W-2, so if you're high net worth, your W-2 income, your active income, passive capital gains without really practically any limits, which is fantastic. And we'll show you an example of that. Return of capital, the aim is to return your capital in the first 2 to 3 years. Again, unlike other private equity investment that you might have made, or really just like any other type of investments you may have made, where you might have seen that pop in the fifth year or the seventh year. In oil and gas, the aim is to return your capital in the first 2 to 3 years, which is fantastic. And that's inclusive of tax savings that we'll talk about in a little bit. And in addition to that, you'll also be receiving monthly passive income. So that monthly passive income coming from oil and gas is great, but it also is shielded by a 15% depletion allowance. We'll explain what that is in a little bit, but essentially that cuts the first 15% of your distributions essentially in perpetuity when once you receive the distributions for the lifetime of the well being drilled, right? And then the distributions being made, which is fantastic. 15%.
Well, to clarify, basically saying the first 15% of income is tax-free.
It's tax free. That's right. And then from a correlation perspective, why do we like oil and gas? Because it's uncorrelated with the broader equity market, really, and real estate in general as well. So you think about oil and gas, and you think about as a W-2 employee, you're invested in the stock market. You're invested maybe even in the bond market. Well, when the stock market goes up and down, essentially it's very, very, very highly correlated. So all of the market goes up and down. Yeah, there might be some exceptions, but with oil and gas, it's highly uncorrelated, 0.2 to 0.44, whereas a correlation of 1 is highly correlated. Um, that being said, you also are allowed to diversify from a US only portfolio. So again, if you think about your investments, either in the equity or bond market or real estate, right? Traditionally, if you're investing in real estate, multifamily or single family, you're investing in the US. You're really not investing overseas. Whereas oil and gas is a globally traded commodity. So you're essentially hedging against the bet that the broader market in the US is going up and down with this uncorrelated asset class. And then I think there's one more bullet, Keshav. Yeah, energy has shown to outperform stocks during inflationary spikes. We are anticipating that we are going to see some inflation in the coming months. So, oil and gas and energy investments in general will help you diversify against those inflationary spikes. And by the way, it's not a bad thing that you'll be getting the monthly distributions to maintain that income as well. So, it's both a hedge against inflation as well as it'll provide you the monthly income once distributions start.
To round that out here at a high level, in addition to tax deductions of 80 to 90% in year one, depending on your tax bracket and your location, like whether you live in California, which has 10% state income tax, or Texas with no state income tax, you're typically looking at a tax savings of, call it 30 to 40%, right? Actual tax savings. So every 100K, you're going to get 80 to 90K tax deductions. Actual cash back in your pocket is more like 30 to 40K. On top of that, which we'll cover later on as well, in year one, you'll typically get 30 to 40%. The numbers are kind of similar, 30 to 40% in income conservatively from cash flow, from the monthly passive income. So for me, when I made my first investment 2 years ago, in November of 2023, at the end of 2024, 1 year later, I had gotten 70% of my investment back already. At that point, what you can do is then take that 70% and put it back into the stock market or back into real estate, however you would have invested it otherwise. But you're basically setting yourself up for two investments using the same 100K. So 100K once sets you up into oil and gas investment. You get that money back really quickly within most of it within year one, all of it within year two or three, and then you can go reinvest it again into real estate or the stock market. But this oil and gas investment will still pay you for the next 5 to 10 years, even though you've gotten your money back. So
Yep.
that's something that I want to highlight there.
So this slide talks about oil and gas being persistent in the market. You've heard about renewables such as EVs, solar. You've heard about hydro and nuclear. Well, that really only accounts for about 18% of the total market. Oh, you're not sharing your screen anymore. 18%
Yeah,
of
I'm
the
gonna
total
switch.
market. Um, and oil and gas remains critical as a energy source of energy for the world's needs. So if you think about like essentially oil represents 32%, natural gas 23, coal 26. All told, it represents about 82% of the energy that's being consumed in the world, right? And that's only going up. So investors are really allocating um, among this volatility, they're allocating more and more to oil and gas rather than to the traditional equity and bond market. Um, if you go to the next couple of bullets, you'll also see that exposure to oil and gas has been increasing from a commodity ownership perspective, and correlation to global growth has also, you go to the next bullet, you also see that the correlation, because of the correlation or inverse correlation to the stock market, it's being adopted by the broader community as an asset class that they're investing in.
Real quick,
This,
real quick
yep,
aside, we got a question in that's asking where we can find the recording. Our recordings here of these podcasts can always be found on YouTube if you search for Clive Capital, and then on all the major podcasting platforms and on Spotify, Apple Music, etc. If you search for Investing for Generational Wealth, it'll be there as well.
yep, thank you for that. So this slide talks about smart money. So we know that Warren Buffett, the Oracle of Omaha, private equity firms, OPEC, like UAE and Abu Dhabi. I'm not going to read all of this, but they're investing in oil and gas. And why are they investing in oil and gas? Because they see that A, the power of oil and gas, right? But they also see the uncorrelation of oil and gas, and they also see that the world continues to need oil and gas as a source of energy. So Warren Buffett invested $28 billion to get about 28% of Occidental Petroleum, and he has the approval to buy up to 50%. That's how much he loves oil and gas, how much he thinks that oil and gas will continue to run up. UAE, as you see here with OPEC, they're not only investing in oil and gas overseas, they've launched a $5 billion fund in 2023 to invest here in the US in oil and gas, which is fantastic. So that also is a thumbs up in terms of approval of US oil and gas. Blackstone, KKR, Warburg, Apollo, all these private equity firms, they're investing billions of dollars into oil and gas. And why? Because they also see the value of oil and gas running up in 2022, 2023, and then into the future years as well. So it's not just us talking about oil and gas and the benefits of oil and gas. It's private equity is touting the power of oil and gas as well. This slide talks about the tax benefits. You'll see that again, it can offset any income, W-2, active, passive. So if you have and want to shield your income, W-2 income from taxes, guess what? Oil and gas can do that for you. Very few other asset classes can do that and can say that they can do that. Um, how did they do that? Well, IRS tax code um, has has designated oil and gas as exploratory, and because they've done that, they have this tax deduction called the intangible drilling cost deduction, or IDC for short, and you'll hear that referred to across the and further on in the presentation as well. What these are non-recoverable expenses, the non-tangible expenses that essentially you can deduct because of this IRS tax code. 100% of that those deductions can be made in the year that you invest, up to 60 to 80%. What that means is if you invest 100K, you can invest and you can deduct up to 60 to 80% of that 100K in that first year, which is fantastic. There are
That
tangible
that
drilling. Go
that
ahead, sorry.
60 to 80% is just on intangible drilling costs also.
Intangible drilling costs. That's right.
So the
There
remaining
are,
amount, like the 10, 15, 20% is from tangible.
yeah. So there are tangible drilling costs, which is Kishan was saying, it's not as significant, and so we don't really focus on that. That's also 100% tax deductible, but it's capitalized and depreciated over a 7-year period, unlike the intangible IDCs, which are tax deductible in the first year. Tangible drilling costs are capitalized, depreciated over a 7-year period. So that's something that we don't focus on as much. It's really IDC is the tax benefit that you would see from oil and gas. And of course, the last bit is depletion allowance. We talked about that in a little bit. Again, because it's exploratory and it's a small operator that we're considering, although we partner with large operators. Um, since IRS tax code deems this exploratory, they are also offering a 15% depletion allowance. That means the first 15% of your distributions, gross income, is tax-free. It's not taxed, right? And then thereafter, it's taxed. And this is in perpetuity. As long as the well is in operation and it's not plugged, then you get this 15% every single year, which is fantastic. So, in summary,
It,
go ahead.
you go first.
No, I was gonna just go to the next bullets. It's like yeah, go ahead.
Yeah,
So,
yeah. So in
your
summary
position.
here, well, two things that I want to point out. One is in real estate, a lot of real estate investors typically have to worry about what's called depreciation recapture tax, where depreciation benefits you take along the way. If you sell before the depreciation, timeline, which is 27 years, which most people are selling before then, you have to pay what's called depreciation recapture tax, 25% on any depreciation tax benefits that you took. Here, to our knowledge, that's not as much of an issue because in real estate with the recapture, the depreciation you took, the asset is still standing there. There's recoverable value. Here, with the expenses and how we're getting our deductions, most of the deductions come from non-recoverable one-time expenses in the intangible drilling costs. So once you pay someone to drill a well, once you buy some chemicals and use them up when you're going to drill, you can't recover those expenses. So there's no such thing when it comes to intangible drilling costs as recapture. There is potential for recapture on the tangible drilling costs, but we'll cover that in future slides or future presentations on how we avoid that. It is very minimal. considering that tangible drilling costs represent a small portion of the overall tax benefit. Second is a question we got in the chat. You said you could take your returns and invest in stock market or in real estate. Why not back into oil and gas? Is there a limit? And that's a great question. Tax strategies out there sometimes have limits, like, hey, you can only deduct up to 30% of your AGI, adjusted gross income, or you can only deduct up to 50%. There are limits. With oil and gas, there are no such limits as to how much you can invest from a legal or tax perspective. Now, from a personal perspective, it just depends how much of an appetite you have for oil and gas in your portfolio.
Right. I always think about diversification, and we'll get to that in future slides. These this slide really talks about diversification, as we just mentioned. You really want to diversify beyond equities, and this is why we bring multiple asset classes to our investor base, oil and gas being one of them. And the reason why we love oil and gas is because it's so uncorrelated. So if you look at the global energy investment projected at $3.3 trillion in oil and gas is running that up. And then, of course, geopolitical events also run up the price of oil. The conflict in the Middle East, Russian sanctions, uncertainty, right, is driving the both investors as well as the U.S. toward energy security. We don't want to rely on other countries for delivery of our oil and gas needs. Wall Street, in turn, is also seeing this, and they are we're seeing an inflow of investment into energy as that inflationary hedge, right? Next, let's talk about supply side and then demand side. So supply side, on the supply side, U.S. crude oil production forecast to increase 13.4 million barrels per day. A lot of it is in the Permian Basin, and we'll talk about where all the different regions are, but Permian Basin in Texas accounts for about 50% of the U.S. oil. We want to see diversification, but Permian Basin seems to be the gold mine, to use an analogy, of oil and gas, and then 20% of that is gas. 50% of that, a little over 50, is the rig count, where the rigs are. And then from a global supply perspective, they're projected to rise 2.3 million barrels per day, which is phenomenal. And then OPEC, of course, is ramping up supply, but also in turn, US, you saw all the private equity investments into the US. US is ramping up its supply as well. Right. On the next slide, demand side, global oil demand is rising, 740,000 barrels per day. And then, China is not consuming as much. That's great, but that is buttressed by the long-term undersupply. As much as you saw that we were increasing supply, there is a long-term undersupply risk. And so that's buttressing the short-term price volatility. Oil prices, if you think about inflationary period, we're entering into an inflationary period, and oil prices typically rise. Here it says rise about 35% during the past inflationary periods, which is essentially beneficial for us as investors in oil and gas. That means that the price per oil is going to increase. That means our investments are going to increase in turn, which is fantastic. And from here, I'm going to pass it on to Keshav to talk about strategy.
Thanks, John. So John mentioned, obviously the overview of why we invest into oil and gas for the great tax benefits, the quick return of capital, majority from year one of your investment. And a question that we had come in related, do you get back your original principal or just the returns and dividends make up for the investment? The return of principal that I'm referring to is from the dividends. And so this is very different from what a lot of people are used to investing in the stock market and crypto and real estate in businesses. You have a basis, basically, right? Like a principal investment, and that's not going away. Here, it's oil and gas. It is a depleting resource. And so there is no such thing as, recovering your investment or anything like that, or return of principal. It is a return of capital through monthly dividends, and you'll make your principal back through that return of capital in 2 to 3 years, conservatively, including tax savings. So all of that, we understand why it makes sense to invest. We understand the big firms, the big investors are piling into energy as well. So how can we ourselves get involved into oil and gas investments? So number one, with business and with investments and a lot of things in life, it's about who and not as much how. So we look to partner with industry experts. We ourselves are getting ramped up on the oil and gas space. Our partners in this business who helped find us our deals and who got me into this industry, they've been doing this for 18 years now. Then they help us find deals by partnering with major drilling companies. These are public companies like EOG Resources. That's a company that our partners have done deals with, and they're publicly traded, as well as private drilling companies as well. We only go into top producing areas. So the Permian out in West Texas, the Eagle Ford, which is South Texas, the Anadarko, which is North Texas and Oklahoma, the Niobrara, which is Wyoming, Colorado, and Nebraska, and the Bakken, and that's in North Dakota. We don't look for deals in Louisiana, even though oil is there. We just don't feel comfortable. There's oil in Pennsylvania and New York. Here, that's where oil was first discovered. We don't look for oil here either. We focus on these five basins because they are the most reliable. And lastly is diversification. So the number one risk that we get from investors is what happens if the well is dry. So one, and we'll cover this a little later, but one of the big ways we mitigate that, very small risk, but we still like to mitigate it, is by investing into multiple wells. Previously, it had been 8 to 10 wells, and now with the upcoming $100 million fund that we're launching, we're actually expanding to include 50 to 100 wells. So our investors' investment will be spread across 50 to 100 wells. And so these are some of the metrics and the experience that we personally rely on our partners who are more experienced than we are when we're looking at new opportunities. So our partners have done more than 170 of these oil and gas deals, invested into more than 1,000 wells, which have produced more than 145 million barrels of oil and 750 billion cubic feet of natural gas. Again, all over the last 18 years. I'll point out over the 1,000 wells, only six of them were dry, and another four of them were they weren't dry, but it was difficult to get to the oil. The rock formations underneath the earth just made it commercially unviable to get to it. So that's 10 out of 1,000 wells that didn't pan out. That's a 1% chance that you strike, or yeah, that you strike out. So we talked about all the benefits. Obviously, no investment is without its risks. But as smart investors, we like to mitigate our risks rather than completely avoid them. If we want to avoid risk, we would just put cash under our bed or in, treasuries or bonds. But we don't want to do that. So number one is uncertain returns. I always tell people investing in oil and gas is like investing in the stock market. I can't tell you exactly where Meta stock is going to be 5 years from now or where Amazon stock is going to be 5 years from now. We can provide general guidance that, hey, over the last, 10, 15 years, the stock market as a whole has averaged 10% return. Maybe tech stocks have averaged 15% return. The 15% I'm not 100% sure of. But it's similar in that sense with oil and gas investing. The price of oil is just as volatile as the stock market is too. It will react to the slightest news of a recession, slowing down demand, a war breaking out somewhere, sanctions, you name it. So that's part of the uncertainty. There's geopolitical uncertainties because it's a global commodity. Another uncertainty that we have is how much oil is this well going to produce? And one of the ways that we mitigate that is by looking at the offset production, which I will cover here in a few slides, where we basically look at what nearby wells are producing, and we take an average of that to be what our lifetime capacity could be for this well. But it's some part of an art and some part of a science. There's no exact saying, hey, this is going to return me exactly 1,034,519 barrels of oil. It's not that easy. because it is Mother Nature. We don't know how much oil or natural gas is down there. But the way that we mitigate the uncertain returns is through a diversified portfolio of wells where we're drilling, right? Like individual wells, the basins, which of those five basins I mentioned earlier we're going into, and operators, different drilling companies. And as with all things in life, you're going to have, some that underperform, some wells that underperform. Most of them will perform in within the range that you expect. And then you'll have a couple of superstars that hit like 50% more production than you expect, or even double the output of oil production that you originally came in expecting. So there's uncertainty there. The commodity price volatility I alluded to earlier. It is a very volatile commodity. The way we mitigate that is by one, ensuring that we're investing with top companies. And when we do that, these top companies benefit from economies of scale. And so their break even is lower, typically $35 to $40 a barrel. What that means is we can still sell oil at $41 a barrel and still be profitable. And for reference, right now, oil is sitting at $62 a barrel. Over the last 5 years, including COVID, when oil prices went really low because no one was traveling, oil averaged $72 a barrel. So, the other way that we mitigate commodity price volatility is by being conservative in how we project our pricing. So, we projecting that in our upcoming investments, that oil will average $72 a barrel over the next 5 years. That's conservative for two reasons. One, that was the price over the last 5 years, 2020 to 2025, including when COVID brought oil prices down to $20 a barrel, maybe even negative. That's what the price was, including that $72, it still averaged. And two, we're being conservative because oil prices and commodities typically track inflation. And we've gone through a lot of inflation over the last 5 years. As John alluded to, we're probably going to go through some more inflation, sticky inflation in the coming years. We're going to benefit from that. But that's not still something we're going to account for. We'll say, hey, to be conservative, we're still going to account for when COVID prices tanked oil, and we're going to account for the last 5 years of oil prices without accounting for inflation driving it up going forward. No assurance of commercial production. So the couple of ways that we mitigate this is one, we invest with top tier operators who know what they're doing. They're not just going to go drill everywhere in the country. They're going to hone in on certain areas that they know produce really well. And again, as we mentioned, in over 1,100 wells that our partners have participated in, six have failed to produce commercially demonstrating uh, commercial volumes, and then another four were difficult to extract. They would have, but it was just difficult to actually extract it from those wells. Again, overall, a 1% failure rate, still pretty good. And the other way we mitigate this is by waiting until the wells are actually drilled. We will wait until wells are drilled to go in and invest. We won't do what is called wildcatting, where we invest into the exploratory phase of testing out whether, this particular area has oil and gas or not. We'll wait for a company like an Exxon, for example, to go in to start buying up land in the area. And if they do that, that means, when once we get wind of it, that means we know that they know that there's a lot of oil and gas there. So once the big players have done their homework, we come in, we pay a slightly higher premium because it's more valuable now. The land is more valuable because it's already been drilled, but our risk is lower. And so that's another way we mitigate no assurance of commercial production or dry holes, is waiting until they've started drilling to say, hey, okay, now we feel comfortable going in and investing. Delays in drilling and operations. So we typically acquire 3 to 10% equity stakes in these wells. That's another way to mitigate risk, is we're not acquiring the lion's share of the project. We acquire a minority stake in the project and we diversify across multiple wells. What that means, though, is that we're not calling the shots we're not telling the drilling company, hey, Exxon, I want you to drill now, or I want you to drill yesterday. They get to decide when they want to drill. We are at their mercy. And that's why I say we don't exactly know when they're going to start uh, operating these drills or when they're going to start paying out. In some cases, it can actually benefit investors if the drilling company decides to wait for stronger oil prices, right? Again, we typically go in until after, like we wait until they've been drilled, but sometimes they could pause extraction or, things like that. And then another reason for multiple wells, which is what we love to do. Again, previously 10 wells to a project. Going forward, it's going to be more like 50 to 100 wells per project. Is even though one company might pause drilling, another company will continue drilling. So we hedge our bets there as well. Lastly, monthly lease operating expenses, LOEs, that exceeds income. That basically says that you're in the red. So what happens when our monthly expenses are higher than the income we're bringing in because oil prices are so low? One, one way we mitigate that is by mitigating who we're investing with, right? Like that's something we pay attention to, again, with big companies. And then second, we have a contingency fund to cover those rainy days the couple of months where we do have to come out of pocket for expenses.
Hey, Keshav, we have a question that came in. What is the life of the investment? How many years into it can I expect returns? And can you
Yeah,
talk about
these
traditional oil and gas investments and then this particular fund?
Yeah, so these wells produce for 15, 20 plus years, especially as technology continues to improve. We're able to extend the life of how long we're able to, of these wells and how long we're able to extract oil out of them. But in the fund and that's previously what we would do. We would just hold it until it continues to produce oil. Because if you get your money back in 2 to 3 years between a combination of tax savings and the monthly dividends, you don't have skin in the game anymore, right? You have no capital tied up. You got your initial principal back. Anything on top of that is gravy, right? It's expected, but it's basically an infinite return in the sense that you don't have any capital in the deal, but it is still paying you. And that's always the spot we want to be in. That's why we previously used to hold on to these until the well stopped producing. In the fund going forward, we will hold on to these wells for between 5 to 10 years until we've squeezed most of the juice, most of the oil out of the wells. And then we will sell at that point. The exit depends on one, we have to deplete it enough so that we don't face depreciation recapture tax on some of the tax benefits that we took, right? Not all of it, but some of it. And then two, another thing always is if we bought these wells and let's say BlackRock came to us next year and said, "Hey, we love this portfolio you've gathered. We'll give you 3x in 1 year." We would obviously take that, right? Or if a bunch of wells were found on our land and 5 years in, then that's another reason we would exit early is because it just makes so much sense to exit. The profit is there that we would consider selling before that 5 to 10 year time frame.
Okay.
So due diligence and documentation, again, as I mentioned, our business plan here, we wait for big companies to go in and start buying land in an area. Once they have started buying land, we get wind of it from our landmen. It's analogous to realtors in real estate. Landmen track the transactions of mineral land in oil and gas. And there's a show on Netflix called Landmen too. So once we get wind from them that, hey, Exxon is coming in buying all this land, we go in and we buy land. We buy typically either equity interest in the wells themselves or in the rights to the land. We will buy that and we will also put up money for the equipment as well for the project. And by doing that, that's how we buy our 3 to 10% equity stake in these projects. And so when we ask about how do we know that we indeed do own 3 to 10% in these projects, one of the documents that is recorded is called a wellbore assignment. So this basically just shows that, hey, we own equity in these oil and gas leases here. All of these documents are provided and can be confirmed or verified through third party governmental agencies. This industry is highly regulated. And so this is government data that shows how much this particular well produced or has been producing. So it shows the barrels of oil it's produced and the million cubic feet of natural gas that it's produced as well as even the water. Some when when you drill underneath the ground, sometimes you'll come across water as well. Offset production. This is what I was talking about earlier about how do we estimate the lifetime capacity of these oil and gas wells. So we bought 4 wells here with EOG, and they are a publicly traded company, EOG Resources, invested into their project, and I believe this is Campbell County, Wyoming. We go in and see, using this public data here, what other nearby wells produced, how long they've been online, and how much they've produced. Some of the text here is cut off. It's a little hard to read, but you'll see that, hey, these 4 wells, right, in the close proximity, this one looks like it produced 414,000 barrels of oil in the last 5 years, right? It's kind of like doing comps when you're in real estate, looking at properties nearby and how much they sold for. This is the oil and gas equivalent of that. So, what we do first, as we mentioned, is we seek partners with expertise who have a balanced mix of upstream, meaning actual production, and midstream, infrastructure investments for dual source cash flow. Second, we partner with institutional grade operators. So, if it's your first day drilling a well, sorry, but we're probably not investing with you. And then third, we have exposure to more wells. We diversify across multiple wells, multiple basins, multiple drilling companies. And lastly, from our team, we have hands-on management, co-investment. John and I have both invested into these and will continue to invest into it pretty heavily. And just transparent education forward investment experience for our investors. And that's what even this podcast, this episode is about. It's just telling you about how oil and gas investments work. So part of that is developing an underwriting criteria. We don't want to just go out there and buy anything we find. Again, top operators, top areas in the country, low break-even price. We need that tax deduction of 80 to 90% to be in there. Otherwise, we're paying too much for it. An average estimated lifetime capacity production of 500 to 800,000 barrels of oil per well, or a 2 to 3.5x potential on capital. And at most, a 10% ownership in each well. Again, that mitigates our risk in putting too many of our eggs in one well. And this is what investors can expect once they do invest, right? Again, from start to finish, big drilling company like Exxon starts buying up land somewhere. Landmen tell us we go in and buy land, or we buy rights to the land or rights to the specific well itself. We put up money for the equipment. We raise capital from our investors. We take the deductions. Here's what it looks like once you can invest, or once you do invest. Monthly drilling partnership reports. So this gives you monthly updates on how the investment is going, what the production numbers are, things like that. And it typically includes distribution and productions for each wells, line item expenses and check details, monthly cash flow, monthly cash distributions. I joke that the beginning of the month is a sad time because that's when I have to pay rent. And the only thing that offsets that is my oil and gas investments that pay me at the same time also. Annual tax documents. We issue a Schedule K-1 tax form around March every year. And lastly, regular communication on production, payments, and process. John and I are always here for questions through call, text, email, and we send you monthly updates as well about the progress of how the investment's going. So some case studies here, the K1 for an actual investment. Here, our investment minimum is 100,000 for these opportunities, for these oil and gas opportunities, just with all of the demand that we've been getting from investors, and there's not much wiggle room there on that. But the reason they love investing so much is here's the tax form from an investor who invested in one of the first few opportunities. Invested 100,000, And in year one for 2023, received $82,000 tax deduction. And this is that 80 to 9% K1 loss that we're talking about. We zoom in here to just show you that net income loss. It shows up as an ordinary business income loss here, self-employment earnings loss here. That's what you get to take against your W-2 and capital gains, any other sort of income that you have. And again, just think about what impact that would have on your cash flow. Depending on your tax situation, that's a savings of 30 to 40%. So every 100K invested, 80 to 90K in deductions, 30 to 40K in actual cash back in your pocket from tax savings.
Oh,
So,
the image didn't come through apparently.
oh,
Uh,
the image did not come through. Okay.
yeah.
Uh, is it, like, should I just escape
If you
out
do
of
a
here?
refresh,
Okay.
yeah, there it is. It came through there.
Okay.
Go ahead.
We'll splice that part out.
Yeah.
Here, for that same investment, for 2024, another investor was gracious enough to give us their tax return. They invested 150,000. They got their tax deduction in 2023. They made a $64,000 income, passive income in 2024, right? That is a roughly 40% return in just their first year. And this is what I was talking about in the first slide. Tax savings, call it 30% conservatively that you get on your return. And then in year one, you're going to get a 40% return, typically from the actual monthly dividends. So that's a 70% return just in year one from a combination of tax savings and the monthly dividends. And
And
you
you'll see
have
the
most of, go ahead.
I was gonna say you'll see the $12,000 depletion allowance, the negative amount, which shields some of the 64,000 in income, which is great.
I don't know that's the depletion, that could be the depletion allowance.
Yeah. You can't tell from here, but yeah.
Yeah, yeah. It could be 64,786 times 15. It sounds like it. I don't know. Um, but the getting back to it, 70% of your capital back in year one. Again, you can go invest it back into real estate, the stock market, or like someone asked you on the webinar, you can put it into your next oil and gas investment. That's really powerful. So now we're going to walk through some specific numbers here. These are all approximations just for educational purposes to show you the power of oil and gas investing. Let's say you invested 500,000. Let's say your W-2 income is $500,000. You're in big tech, you're a doctor, you're a lawyer, whatever it is, you're doing really well for yourself and for your family, your loved ones. You're going to lose $184,000 of that to taxes. Your marginal tax rate's 37% at the federal level. Depending on your state, you could have up to 10% of state and local income tax as well in places like California and New York. When you combine all of that, your tax liability is $184,000. The federal portion of that here is roughly $137,000. The 10% state and local income tax is $47,000. That's your before. That's how much you are giving up, leaving on the table, handing over to someone else that you could have otherwise kept in your own pocket. After you invest in oil and gas, your W-2 income is obviously the same, 500,000, but let's say you invest 100,000 into an opportunity. Your first year income, conservatively, let's call it $30,000. After that, you're going to have a 15% depletion allowance. So you don't have to pay taxes on $4,500 of that $30,000. So that reduces your taxable income there. You reduce your taxes by $85,000, and there's a federal tax savings on that $85,000 of $33,000. You also save on state and local income tax, again, assuming you have it, assuming it's 10%, you save about $10,000. Obviously, the income that you make, the remaining of the $30,000, the $25,500 that is subject to tax, that's going to be taxed as well. All in all, when you combine your tax savings and your post-tax oil and gas income, you have made an additional roughly $72,000. That is a 23% increase in the take-home cash that you have for a year. So every year, obviously this is specific to this tax bracket, these, these tax situations, you are leaving money on the table through tax savings and income. So in the end, our W-2 earner who makes 500,000 ended up making more, made 530,000 and kept more of it. So obviously the question is, hey, that sounds great. Why don't I just put everything in it so I can write off all my taxes, right? One, it's a 80 cents on the dollar deduction, so you're never going to completely wipe out your taxes with just oil and gas alone. And two, we like to diversify, right? We don't want anyone getting, falling over or something when oil prices hit $50 or $60, which it is right now. You want to hedge your bets. So this is what we typically project for the different investment opportunities that we bring for multifamily apartment buildings that we're acquiring, typically 15 to 20% IRR, industrial real estate, 14 to 16% IRR, private debt, 16 to 18%, ground up construction and build to rent, 20 to 25%, but that's ground up construction. Risks are a little higher. Oil and gas, 20 to 25% as well. Conservatively call it 20%, including the tax savings, given where oil is right now, at least. If oil goes higher, then it will be more towards that 25% range. You'll see that oil and gas is on the higher end of the returns when it comes to internal rate of return, IRR. You'll see that its tax benefits are higher, 80 to 85%, and you can use it to offset your W-2 income or capital gains, which you cannot do anywhere else. And cash flow in the early years is also a lot higher. So the first year, it might be 30 to 40%. Year two, it declines. It may be 20 to 30% because oil and gas is a depleting resource. So over time, your returns are actually going to decrease. But even accounting for that decrease, because you get so much money up front, that's why our internal rate of return is higher. So I won't go through all of this, but this is just how we think about how we allocate our investments and what we recommend to our investors. And we have the average stock market here. This is obviously not what you would get if you handpicked your stocks or if you just put it all in Nvidia. This is what the stock market has averaged over the last 15 years as a whole. This is how our investors have allocated their capital with us. Most of our investors, when they've invested with us, have put their money into oil and gas first because of the tax benefits and the passive income. And this is how they invest. Most of them are using cash to invest. A good amount of them are using retirement accounts as well, your 401ks and Roth IRAs. But for oil and gas, we don't recommend using 401ks and Roth IRAs because you don't get to benefit from the tax benefits.
And I would say it also depends on where you are in your investment life cycle, as well as as well as your life. Like if you're still a high W-2 or high net worth individual, you might want to shield a lot of the taxes through oil and gas. Definitely use that as an asset class to do that. If you need the passive income, you might look at private debt, you might look at oil and gas. So it really depends on where you are. Do talk to us about that. We can help you allocate accordingly.
And that comes to the end. Now we're going to round out with some frequently asked questions. These are some questions that our, database or network sent us ahead of time that they wanted to learn more about. Why can't I just invest in oil and gas ETFs, such as USO or XLE? That is because you won't get the tax benefits. The tax benefits come from direct ownership into the wells. Your income is going to be a lot, it's not going to be as direct to the source. When you're a public company, there's a lot of compliance and reporting and admin and just bloat that you have to face. With some of these companies, they might not be as big as Exxon, but they have, the required level of experience to go out and drill, and they're not nearly as bloated. Two, how does the transition to renewable energy sources affect oil and gas investments? Oil and gas, as John showed earlier, still accounts for 80% of the world's energy supply. That's just energy. Now also incorporate the fact that 6,000 daily products come from oil and gas byproducts, pharmaceuticals, makeup, shoelaces, electronics, even the equipment needed to make renewable energy sources, your Tesla cars, your solar panels, your wind turbines, they all contain components that are byproducts of oil and gas. So in the near term, we don't see oil and gas going anywhere, especially considering the, long-term undersupply risk that has encouraged a lot of institutional investors like Warren Buffett, the UAE, and other private equity companies like BlackRock to invest. They wouldn't be investing if they thought green was the future, was the only future. What is the importance of due diligence before investing in oil and gas opportunities? It is paramount, especially in oil and gas, because oil and gas is less well understood than other syndication investments in real estate and private lending. And a lot of folks like to dangle that tax benefit in front of you as a carrot to get a lot of otherwise innocent or unknowing investors to invest. I myself, when I was first looking at investing into oil and gas 30 years, almost pulled the trigger and invested into a company that will likely come out in the news for being fraudulent or scammy in the next few years. But luckily, I met the partners that I work with now. They were really transparent, took the time to educate me, and that is why I went with them. And that's why I invested myself first 2 years ago. And then once I saw the tax benefits and the returns, we've now been investing into oil and gas for our investors, helping them allocate into oil and gas for the last 9, 10 months. Should I invest if I'm ethically opposed to big oil? That's a personal question. But just know that oil and gas isn't going anywhere, and that if you wanted to really reduce or eliminate your dependence on it, your home would probably be empty. There's not a lot of materials that don't have
Right.
oil and gas in them. You can't drive your car anywhere. Your electricity comes from natural gas, your cooking, things like that. So
Most plastics, yep.
most plastics, that's something to consider. Not now, what you could do is also invest into green energy, which that's something we're exploring as well. But for the foreseeable future, oil and gas is necessary to keep our civilization going. What is the expected production decline? So year one, you're typically going to get anywhere between, these ranges are very wide, but again, it goes back to why oil and gas investing is not as predictable as real estate, for example, or private lending. Year one, you're typically going to produce 20 to 40% of the lifetime of the oil wells. And then year two, year three is going to keep decreasing. Typically by year five, you've produced and extracted 80% of the lifetime capacity of the oil well. The exit strategy, as I mentioned previously was to hold until the wells stop producing. Now we will be going forward on the new $100 million fund and future funds that we launch. We will be exiting probably within 5 to 10 years once we have extracted the vast majority of the oil from the well. Continued, what kinds of income can the tax deduction generated by these investments offset? As far as our CPAs have told us, all types of income. Again, highly recommend, encourage, require that you check with your own CPA. Feel free to show them a sample K1 tax form, which we had here, and they should be able to tell you, what you can deduct. But that's the feedback that we've gotten. And I've filed taxes for it 2 years now. Our partners have been doing it for 18 years. So let's see. Can I invest as an LP or a GP? So we'll end out with this one. Can I invest as LP or GP? LP stands for limited partner, GP stands for general partner. And to get the deductions in year one to reduce your W-2 income or capital gains, you need to invest as a general partner. And then typically in year two onwards, you get converted back to being a limited partner. If you invest as a limited partner, you will still get the deductions. You cannot use it against your W-2 income though. The GP status, general partner status, does it require active participation in other industries or assets like real estate? It typically does. Oil and gas, it does not. And this one's a bit more of a loaded question. Okay, I'll answer it. So what liability comes with being a GP? What the liability that comes is let's say there's an explosion at one of these wells, right? Or some mishap happens and someone sues. Because we are a part of the partnership, we are on the hook for a portion of that. That should not freak us out from investing or deter us because one, the drilling companies we invest with, they own the majority of the projects, the majority share. As I mentioned, we don't acquire more than 10% of a project. They're typically owning the vast majority of a project. So it's in their best interest if a lawsuit comes, they're on the hook for the biggest part of the bill. And these drilling companies carry massive amounts of insurance, as you might imagine, because accidents happen on oil rigs. So one, any lawsuit would have to first, like that, the claim, whatever the amount is, would have to first exceed the insurance payout. That's one. And then number two, whatever remains, we're on the hook as a partnership for 3 to 10% of that. So the $100 million that we're raising will only go to acquire 3 to 10% equity stake in any single well. So whatever liability on top of the insurance that comes, like whatever to come out of pocket, we across $100 million of investor capital only have to come out of pocket for 3 to 10% of it. So on an individual basis for investors, it likely won't happen. And if it does happen, the liability is very small. Can you invest through a subjected IRA? If you want the tax benefits, you cannot invest through a subjected IRA. And if can you invest through a trust? You can. We leave that up to you, and definitely recommend you consult your asset protection attorney on how you can make that happen. Typically, we recommend in year one that you invest using the legal entity that you want the tax benefits for, whether that's individually, jointly, in a trust, LLC, whatever it is. And then here's our contact information, our cell phone numbers, and our Calendlys as well, and emails. So with that, that's our oil and gas introduction webinar. There's definitely going to be future webinars as we learn more, as our current funds continue to perform, as the landscape changes of investing into oil and gas. We'll have future episodes as well. So my name is Keshav Kalor. John Lai here with me. We're principals, co-founders of Clive Capital. Our contact information is here. Feel free to reach out. And until next time, keep investing for generational wealth.